Joining me right now is Bull-Tick Capital Markets Chief Strategist, Kathryn Rooney Vera. Great to see everybody this morning. Thank you so much for being here. Kathryn, kicking things off with you with a look at interest rates. Atlanta Federal Reserve President Raphael Bostic says the central bank could raise rates by 0.5 point if needed to combat inflation. So Tory Fund founder Dan Niles joined me earlier this month talking about raising rates. He's predicting multiple. Watch this.
I think the Fed's going to raise rates 5 to 6 times. I think they're going to start to work down their balance sheet this year, and I think you're going to have 10-year treasuries get close to 3% when all said and done in 2022, and I think that's going to drive a 20% correction in the stock market, the S&P 500, at some point during the year, because I think you're going to see multiples compress a lot.
Kathryn, what's your reaction and what are you expecting? You think the Fed goes for a 0.5 point hike in March or 1/4 point?
This Fed has always been about should they, but will they? Should they have started tapering 6 to 12 months ago? Yes. Should they increase interest rates 4 to 6 times? Yes, but will they? Remember, Maria and audience, this is really important. This is a Fed that changed the target to an average of 2%. This is a Fed that explicitly said they would let inflation run hot. And this is a Fed that incorporated, remember this, social justice and climate change into their monetary policy purview. So should they? Yes. Will they? Really analyzing the Fed is less about economic analysis and more about psychological, political, and market-driven analysis. They should have started a while ago. Midterms are coming up. And a couple other things that I've been thinking about, Maria, is anything could put the kibosh on what the Fed is today reacting to. Remember that Jay Powell in the last press conference said, we will react to that. This is a reactive Fed. This is still a data-dependent Fed, a Fed that has taken their balance sheet up to $8.5 trillion. Should they have a game plan for the short-term, medium-term, long-term? Yes, but they're still data-dependent. They're still short-term in nature. So they will react to what? A market drop, a new variant, a growth scare, geopolitical risk, or some event, and perhaps even inflation reverting. March is going to see the ugliest inflation print. And then base effects, because inflation was so high last year, is going to take inflation lower. My bet, Maria, is the Fed does fewer than more in terms of the 4 rate hikes that are already priced into the markets.
Yeah, I think this is increasingly, people are wondering whether or not the market disruption will get in the way of the Fed doing all these multiple rate hikes. You know, I think, we're expecting, obviously, rates to go higher, but we'll see how it's met, what it's met with in terms of market reaction. Great word on Wall Street, guys. Thanks very much. Kathryn Rooney Vera, Ryan Dietrich, thanks for joining us.